Hello and welcome to the FCSA IR35 webinar, Are You Ready for IR35? My name is Phil Pluck, I'm the Chief Executive of FCSA, and we're providing a series of webinars which you can keep revisiting in order for you to make sure that you're fully prepared for IR35. In previous webinars, what we've done is look at the components of IR35 reforms that are coming in on the 6th of April. And today, we're asking you, with the guidance of the FCSA, to look at whether your organisation is ready for the IR35 reforms. We have today with us Chris James, who's the Director of Accounting Services for JSA, an FCSA member, and he's also the Chair of FCSA itself. So without further ado, Chris will now take you through all of the components that will make sure that you and your organisation are ready for the IR35 reforms on the 6th of April. Chris, over to you. Thank you.
Thanks very much, Phil. Welcome to this, the second of the FCSA's main off-payroll webinars. This one's going to be have slightly less technical detail around IR35 itself and concentrate more on the real-life impacts on the supply chain of the changes. So we'll go over IR35 itself in brief, and then the off-payroll rules as they are. The transfer of liabilities provisions in the latest version of the legislation. A checklist and the start of a project plan for off-payroll compliance. What you should do about knowing who's in your supply chain, and the commercial risks of blanket banning PSCs, which is one of the approaches some end users have taken when faced with the legislation, at least at first. What we saw in the public sector and what that experience tells us, and FCSA's summary of the new rules and how we can help. So first off, a necessary reminder, please, IR35 and off-payroll is very, very complicated. This webinar is intended to give a high-level overview of what the rules are and to suggest strategies that you might use to comply with the legislation in the new world. You do need to take advice, though, that's tailored to your specific circumstances, and you can't just rely on something you read or view in a webinar like this. So in very much the same way as an employment status determination is based on the unique circumstances that you find when you're looking at a situation, so is the exact right approach for you. So please do take expert advice about this important topic. Okay, I'm Chris James. Phil introduced me briefly earlier. I'm the Director of Accounting at JSA Group, which is a member of the FCSA. I'm a chartered accountant and former auditor, and I speak a lot about employment status and the implications of that on the supply chain. I've been a member of the FCSA board since 2017 and the chair of the board since 2018. And I regularly meet with the people who have written the off-payroll legislation, who are in charge of thinking about policy and how it's implemented. And so I've got a good idea about what they were trying to achieve with this latest version of the legislation and how far they have succeeded in that aim. So let's go back to basics. Think about a recruitment supply chain with a PSC in it. Here we have an end user at the top of the chain, an agency underneath it. And in this case, we have a PSC, which is called Dave Limited, and that's supplying the services of a worker, Dave, at the bottom. Alternatively, a very similar supply chain could exist with an umbrella in it, same end user and the same agency. But in this case, an umbrella business is paying the worker, Dave, and Dave's PSC is no longer relevant. The point here is that the supply chains look similar either way, but you've got people paying Dave in two different ways. So an end user requires work to be done, and they source that worker through an agency, probably because the agency's got more access to individuals who could help with what needs doing, or because they're just better at it or more efficient at it or whatever. If, incidentally, an agency isn't involved in the supply chain, then these rules still apply. It's just that there isn't a separate fee payer. We'll see later on what that means with the diagram of the supply chain. The agency arranges payment of the worker after deducting their profit margin, and then they'll either pay a PSC direct, and then the PSC will pay the worker and deal with any of the taxes due, or they might pay the worker as an employee of the agency itself with full PAYE applied, or they might pay an umbrella company to payroll the worker, and the payment the umbrella company makes to the worker will have full PAYE applied. So how does IR35 fit into this? Well, the old IR35 rules, the original rules that have been around for about 25 years, IR35 incidentally just stands for Inland Revenue, the old name for HMRC, notice number 35, IR35, that's all it means. And it says that if someone is acting like an employee, but working through an intermediary, so a PSC, then they need to pay tax on their invoices like an employee would broadly on a salary. But the key point is that's only if someone's actually acting like an employee, then their engagement through the PSC is looked at again for tax purposes and more tax is deducted or is deductible. But the point here is that, yeah, it's only if the person is acting like an employee. If they're not, then it's perfectly reasonable for the supply chain to pay a PSC and for the PSC to pay the worker in whatever way is most tax efficient. Old IR35 says that we take the invoice value, so if we've invoiced £10,000 for a month or two's worth of work, we deduct 5% from that, and we say that the remaining 95% is gross pay with employers' national insurance on top of it. And then Dave Limited, the company, payrolls that 95%, and the taxes due are paid over to HMRC by Dave Limited. The agency and the end user are not involved. So that sounded fairly straightforward, as in if someone's acting like an employee, you tax them like an employee, but the difficult question is, of course, how do we work out if someone is acting like an employee? And for this, we have to go back over many years of case law. We look at the situation in place. So Dave is probably has an implied contract with his PSC. The PSC will have a real contract with the agency, and the agency will have a real contract with the end user. Work is being done up the chain and payment is being done down the chain. In simple terms, Dave is doing work for the eventual benefit of the end user, and the end user is paying an amount of money, a significant proportion of which hopefully will be ending up with Dave. So what do? We say, if we ignore all the legal contracts in place initially, the way that Dave is working is that in the manner of an employee, and is the end user therefore acting like a deemed employer. And if they are acting like an employee, we say they're caught or they're inside IR35. So that's the terminology we use. The technical definition of this is that this contract between Dave and the deemed employer, the end user, is imagined. So we look at what's going on in real life and we imagine a contract. We do bear in mind what's in the actual contracts, but the working practices are the most important thing. So the contracts may inform us, give us additional things to think about the imagined contract, but broadly speaking, the core of that imagined contract will be the working practices that are actually in place. And then that imagined contract, we say, is that imagined contract a contract of service, so an employment contract, or a contract for services, a business-to-business contract? And yeah, just a reminder of this, if the working practices and the contract do not agree, then the working practices are the most important point here. So if you've got working practices which suggest an employment relationship, just having a cleverly written contract that says something else will not mean that somebody is not acting like an employee and therefore is not inside IR35. So again, that sounded relatively simple. We imagine a contract and they then say, is it one of employment or not? But how do you decide if something is an employment contract? As I mentioned, you look over these years of case law for the themes that emerge, and then you appraise those themes. So the themes are mutuality of obligation, which is a kind of feeling of continued obligation between the employer, the deemed employer, and the employee. So an expectation that work will be continue to be offered to the employee and that the employee will continue to do it and be paid for it. A lack of that continued feeling of obligations between the two parties, a lack of it means it doesn't look like employment. We look for control in how work is carried out. Any contract between an end user and a PSC or a worker is going to say, I want you to do this, and in exchange for that, I'll give you some money. So there's an element of control. What we're looking at here is controlling how that work is delivered. So in the very detail of how every task involved in that work is carried out. So does the contract define how work is done exactly, or does it just say, I want this done by this date with these key milestones on the way? So a lack of strong control in the day-to-day operations, a lack of that control suggests non-employment. Strong levels of control suggest employment. We also look for substitution, and we look here for a right for the PSC to substitute Dave for somebody else, or substitute somebody else for Dave. It's reasonable if there is a requirement that the substitute is similarly experienced and qualified, can demonstrate that they're capable of doing whatever the work is. But beyond that, the end user shouldn't have the right to refuse a substitute if a perfectly capable substitute is provided. So we look for that right. Is there a right in the contracts and in practice for substitution to occur? We also look for financial risk. So for example, can Dave Limited have to put work right at their own cost? Because that would normally be indicative of a business relationship. Has Dave become part and parcel of the end user's operations? And overall, we ask the question, is the worker, Dave in our example, are they in business on their own account? Is Dave Limited a business, or is Dave Limited a convenience to try and reduce the amount of tax that Dave has to suffer on their take-home pay? So the overall position is considered and a decision on status is then made. So it's not one of these factors, it's all of them together. In most situations, some of them will be more important than others, but all factors are taken into consideration. It's very important if you're using an assessor or an assessment tool that that tool takes all of these factors into consideration. So bearing those simple, straightforward headlines about employment status in mind, I'll just go through some common myths and common questions I get from contractors and supply chains. Are all long engagements caught by IR35? So is it the case, for example, that if a contract lasts longer than a year, it's inside? The answer to that is no, absolutely not. There's no time limit for inside and outside. What is true, though, is that the longer an engagement takes place, the longer a contractor is working for one end user, the more likely it is, we see, that the working practices in place are going to start to look more like employment if they didn't at the beginning. So the risk with a longer engagement is that people get sloppy around working practices when project deliverables change, paperwork isn't done, and so on. So long engagements in themselves are not caught by IR35, but as in there's no threshold, there's no amount of years or months that means something's inside. But longer engagements are generally more likely to have a higher risk of looking like an employment situation, looking like they become inside. I have quite a few contractors that we act for who have more than one client, and sometimes they feel that just because they've got more than one client, that automatically means they're outside IR35. That's not true. Having more than one client doesn't make you or those bits of work outside IR35, but it is true to say that the kind of contractor who either works for several different end clients at once or regularly moves from one client to another client to another client is normally more likely to be operating in a safe outside IR35 situation, purely because they're very used to defining clearly what they will deliver, when they will deliver it. They've got more autonomy generally, they're not very closely controlled. So normally then when you look at the employment status test, they're more likely to be outside IR35. But it's not just by virtue of having more than one client, it's just the kind of contractor who does normally looks more likely to be outside. If your contract says you're not an employee, are you fine? No, as I mentioned earlier. If the working practices are not supported by the contract, then the contract will be ignored in favour of the working practices. So just having a clause that says, I definitely am not an employee, that's not going to mean you're outside IR35 on its own. If your agency can substitute you, is that okay? That's not the right kind of substitution for the employment status test for Dave. It needs to be the PSC who can substitute someone else for Dave. Agencies, of course, partly exist to substitute people. When there aren't enough people to do things, they find other people. So the agency substituting is not the right kind of substitution for this test, I'm afraid. Is it my agency's problem or my end user's problem if my status is incorrect? In the private sector, right now, that is no, it isn't their problem. But of course, the key point with this legislation is from April 21, it may well be. Can an office holder be outside IR35 if they're a temp? So sometimes you see assignments or roles advertised at something like a director of HR in a business. Highly unlikely if someone's filling a permanent office of a business that they can be outside, purely by virtue of being an office holder. HMRC are very clear on this and say, if you're an office holder, you're not going to be outside IR35. And can you get a contractor for maternity cover? Well, broadly speaking, the answer to this is no, absolutely not, because assuming the maternity cover is for someone who is a regular permanent employee, then if a contractor comes in to fulfill those responsibilities, the work they're doing certainly must meet the working practices of an employee. And therefore, in straightforward terms, if a contractor's doing maternity cover, they can't be outside IR35. So that's the background to employment status and how old IR35 works. What's the problem with it? Why have the Revenue decided to change how it operates? Well, in the old IR35 rules, the contractor, Dave, decides if he's inside. Contractors normally pay more tax if they're inside. When contractors look around, they don't see HMRC doing much enforcement. That's certainly the opinion of many contractors. And often if you look at the reporting of cases in the contractor press, you will see that HMRC seem to lose these cases quite often. There is no penalty on end users in the private sector if the contractor gets it wrong. And so there's no real risk for end clients or agencies if the status is wrong. So if Dave says he's outside, but he's not, currently in the private sector, the consequences are all on him. It's HMRC will go after Dave and Dave Limited for those taxes. So HMRC wanted to ensure that the supply chain took more responsibility for the status of contractors. They didn't want to hear end users and agencies saying, we can't be expected to know what happens downwind of us in the supply chain. So they rebooted the IR35 rules into what's known more commonly now as off-payroll or new IR35. IR35 and off-payroll have become a bit interchangeable, but broadly speaking, old IR35 is the contractor deciding if they're inside or outside. People often think of off-payroll as the point at which the end user becomes more involved in the decision. So what are the new rules? The new rules are broadly in the private sector, the ones that are coming in April 21. The responsibility for the decision on status, is this assignment inside or outside IR35, moves to the end user rather than the contractor. And this is true unless the end user is small. More about that in a minute. The financial risk moves from the contractor, who would previously have been liable if HMRC came knocking, to the fee payer, and that's whoever pays the PSC, which will often be an agency in the supply chain. And it can move to the end user as well if certain circumstances apply. The fee payer becomes liable for any underpayment of tax and national insurance. So if the PSC was paid gross, and HMRC are later able to show that employment taxes should have been deducted, so they're able to demonstrate that the assignment was inside, then it's the fee payer they'll go to first for the tax and national insurance that should have been deducted, including employers' national insurance. So therefore, under these new rules, agencies and end clients are taking on a new financial risk as liability can move back up the chain. If workers are being paid via PAYE, so if all of their pay is having PAYE operated on it in accordance with HMRC rules, then the idea of the legislation is that that arrangement will not be touched. So if there's a worker at the bottom of a chain who's being paid by an umbrella, or if they're on agency PAYE, then there shouldn't be any under-collected tax to chase back up the supply chain. And this applies in the private sector to work done from the 6th of April 2021. In earlier iterations of the legislation, it was when payments were made that was crucial. Now it's when the work was done. In the public sector, these rules started in 2017, and I'll talk about that again in a moment. The employment status test, though, so the decision about whether or not someone is inside or outside, which is based on employment status of the imagined contract, that test is the same test, and that's important. So things have changed about IR35, but the employment status test has not changed. And indeed, employment status is still being considered by HMRC and other bodies on a longer running piece of work, which I do hope at some point they will get to the end of. So let's have a look at the supply chain. Here's a long supply chain, but it includes all the typical parts. We have an end client on the left, who is the end client for the purposes of this legislation. There's a supply chain with several agencies in it, and there's a fee payer as well. So the fee payer could be agency 4, or it could be a separate organisation that just does fee paying. And the fee payer is paying the PSC. So that's how we know who the fee payer is. They pay the PSC. So what happened in the public sector? In the public sector in 2017, the first iteration of the new off-payroll rules came in, and it said for public sector end users, such as the NHS, government departments and so on, and this was for payments made from the 6th of April onwards, the end user decides on the status of each assignment, so that's each piece of work. It's not a contractor by contractor assessment as such, it's each assignment has to be assessed. And it says whoever pays the contractor company is liable if they don't deduct tax, and status is later challenged. So an agency, if there is one, if there is no agency, then the end user would be paying the PSC. So it's the end user is also the fee payer, and it would be then that the revenue go to for under-collected tax. There's no 5% to knock off as there was on old IR35. So for contractors in the public sector, should the end user decide that the assignment's caught and the contractor wants to continue using their PSC rather than opt for a payroll option, then the assignment rate, so whatever rate is being paid to the PSC for the work done, is taxed as if it made up all the employment costs to the supply chain. The contractor, therefore, is being taxed like an employee, but gets absolutely no rights. The end user is deciding, but is effectively not liable, because in the public sector, there was less on liability transfer. So the only way the end user could easily become liable is if they were also the fee payer. But in many of these supply chains, there's one or more agencies in the supply chain. And so this is the situation you end up in. At the top, in the middle here, we have an assignment status test done. So the assignment status is assessed by the end user. If over to the left, it's decided that that assignment is inside, then you have a choice of either offering a permanent role with the end user to the worker, or going through a supply chain through a recruitment business or an agency, which either would pay the worker themselves on payroll or use an umbrella to payroll the person. They could indeed as well use other kinds of payroll models such as joint employment, PEO. Provided full tax is being operated on the pay to the worker, then this example would still be true. So the question over on the left is, what rate of pay are we going to have to pay this worker if they were previously used to receiving money on a PSC outside basis? And also we need to ask, if we're going to pay through a supply chain to agencies and umbrellas, how well do we know, what due diligence have we done on those? Because there's a potential risk here if the payments are not being made with full tax applied, or if one of those businesses goes bust. Finally, at the bottom on the left, the other issue is, as well as what rate of pay is going to be paid, some workers who fulfill these kind of assignments don't want to be an employee. They want to be self-employed. That's why they set up the way they did in the first place. And so you may have a restricted talent pool for reasons of people wanting to be freelancers, and also because they're not happy with the rate of pay and how that converts into take-home pay under an employed method. On the right-hand side, the assessment is, if the assessment's outside, we can continue to pay in the same way that we do today, whether via a recruitment agency or not. We pay the PSC gross as before, but there is, of course, a new financial risk under the new regulations that if that outside status is challenged later, there is a risk to the fee payer and potentially to the end client as well, and other agencies in the chain. So the assessment must be of a high standard. So the critical point there is, if the assessment is of a very high standard, then you should only be paying PSCs on an outside basis, so without tax deducted, who genuinely are outside. And if they genuinely are outside, HMRC are unlikely to be able to successfully argue with the decision and then chase tax up and down the supply chain. So the off-payroll rules that originally came in the public sector, and this will be amended when they come into the private sector, are in part of the Income Taxes Act called Chapter 10. The importance of that is that they are new rules. The original old IR35 rules were a different chapter of the legislation, Chapter 8, and both sets of rules apply in the new world. It's not that one of them disappears and the other one takes over. So there's no volume of tribunals or case law to extract many precedents from in terms of how the rules operate. There is lots of case law on employment status, although that's also argued over. But the point is, these new rules that came into the public sector in 17, there is almost no precedent to look back on. The key difference between Chapter 8 and Chapter 10, in Chapter 8, the PSC deals with all taxes due, including employers' national insurance. In Chapter 10, there is an assumption that if a rate has been agreed with a worker and payments are going to be made to the PSC applying the new rules, then employers' national insurance should be added to the rate that's been agreed. This is important because then if you end up paying someone on an employed basis, you must be careful to ensure that they understand what the rate is, understand where the employer's national insurance fits into that, in order that they don't feel that the agreed rate has then been reduced by a deduction of employer's national insurance. Because of course, if you're going to pay someone on an employed basis, employer's national insurance has to be paid by somebody. And so the rates need to allow for that in the discussions with contractors. Very important point. So it shouldn't be taken out of the rate paid to the PSC. New rates should be agreed, but rates didn't always go up, and here's what that looked like. So we have a rate of pay on the left shown by the bracket, the original rate of pay. On an outside IR35 basis, the contractor will be suffering corporation tax and dividend tax, as well as potentially a small amount normally of PAYE and employees' national insurance. And they could structure their take-home pay in the way it's shown on the left. It's perfectly legal, provided they're outside IR35, there's nothing wrong with that. If you took the same gross pay in column 2 and put employment taxes on it, PAYE and employees' national insurance, the take-home pay would reduce by a few percent. Actually, though, of course, if you're going to pay someone that way, someone has to pay employers' national insurance. So the intention of the new off-payroll rules was that the supply chain would find employers' national insurance the cost of the contractor obviously would increase, and therefore the take-home pay is still not a million miles away from where it was on the left-hand side. However, of course, the commercial reality is that supply chains only in some circumstances were able to find the extra money for employers' national insurance. And so sometimes the effective impact of that employers' national insurance was pushed down into the rate and the taxes that the contractor suffered. And the take-home pay, therefore, went down significantly further. So it's important because you've got to understand how your contractors will feel about the changes to the way they're working. And it's also important because that shrinkage of the take-home pay box on the right-hand side is one of the main motivations why, when these rules came in the public sector, and we're seeing the same thing happen again as they approach coming in the private sector, lots and lots of people are setting up new providers offering artificially high amounts of take-home pay. And this is a problem because if those arrangements fall away in future years, it's the contractors that get chased for the money that if they thought they'd paid all their taxes, but it turns out they haven't, the revenue will go after them. And also reputationally for end users and agencies, you don't want to be mixed up in those kind of payment models because more and more nowadays, transparency, clarity, doing due diligence on your supply chain is what HMRC and other government bodies expect. And so it's very important that you don't get involved in those kind of arrangements. So what are the new rules as now coming in April 21, originally drafted to come in April 20, but delayed by the COVID outbreak? It says, for each new assignment and each extension of an assignment, and if anyone notices in the supply chain that circumstances have changed about the assignment, circumstances that were relied upon when reaching status assessment, then the end user, if not small, and more about that in a moment, they must issue what's known as a status determination statement, which confirms the status of the assessment they've made. It says this assignment is inside or outside, and they must pass that to the next party in the chain and to the contractor. They're liable for the taxes due if the revenue are able to show taxes were due and weren't paid, unless they do that. So a good assessment is key, because if you're telling the supply chain, I only want people paid outside who are outside, and here's my confirmation that this assignment is outside, then, as I mentioned before, HMRC are unlikely to have a good case to go after you for underpaid taxes, because you've only paid those people if you think they are genuinely outside IR35, and therefore taxes are not due. The SDS must be issued at the start of a new assignment, and so for assignments, but also for assignments that are in place already in April 21, you're going to have to issue an assignment, and on extension, and if circumstances have changed. I've been asked quite a few times in recent months whether or not, if SDSs were issued in April 2020, ready for April 2020, so in February and March 2020, can those SDSs be used this time round in April 21? The answer is yes, there's nothing to stop you using those assessments, but what you should do in terms of taking reasonable care and for sensible commercial reasons and to avoid any unexpected tax liability is check that all the circumstances that were relied upon when they were originally issued are still true today. So it's going to be sensible to check that very, very carefully before relying on an old SDS. What should the SDS say? It confirms the status of the assignment. It's based on the status assessment, and it's the responsibility of the end user. So the end user can have the supply chain help with these, but the responsibility is the end users. The SDS confirms the status and the reason for the status decision. If the worker or the business paying the worker or the PSC of the worker wants to challenge the status assessment, they can, until the last payment is made for that assignment. The end user has 45 days to respond to that challenge, or they become liable. Although it should be pointed out, in terms of commercial reality, 99% of these challenges would presumably be when the SDS says that an assignment is inside and the worker or the fee payer doesn't agree with that and thinks it's outside. If an end user says an assignment is inside, then the supply chain should be paying that worker with tax deducted. So if the end user doesn't respond to the challenge, they then become liable for taxes, but taxes have been deducted. So it's quite unlikely, really, that there's going to be a tax liability to not following that dispute process. However, you must follow the dispute process. It's part of you as an end user showing that you're taking reasonable care overall in your dealing with the off-payroll rules. So I don't recommend you ignore status disputes for the reason I've just mentioned. The status determination statement, it can be very, very useful, because if it's a good one, it will explain clearly why the status that's been arrived at has been arrived at. That means that contractors are more likely to understand why the decision is the way it is. it might give you an indication that actually status is a bit borderline perhaps, and so certain things can be genuinely changed about the way the contractor or the assignment is operating that might mean the assignment can be made more certainly inside or outside, and that could be helpful to the supply chain and to everyone involved. A good SDS will ensure only truly outside workers are paid without payroll deductions, which protects all members of the supply chain. And a good thing to do with a status assessment tool, if you're ready to use one now, if you haven't started, is if you have a population of contractors in your supply chain, and if they fit into 3 or 4 typical examples of how people work, you could sample assess a few examples of each of those types to find out whether or not your supply chain looks like it's got lots of outside people, lots of inside people or situations, or a mixture of statuses that you can then work on to see what you want to do about that. And of course, assess the impact of having to pay people in a different way going forward, if that's the case, those inside status determinations. There's more detail about the SDS in what's known as the Employment Status Manual. If you look at ESM, in this case 10,012 and 10,013, and there's a full index of all the guidance that HMRC have put out about the off-payroll rules. If you Google ESM 10,000, just 10000, you'll get a kind of contents list of lots of different areas. So first off then, we mentioned the end users have to do this unless they are small. So how do we go through the process of working out whether we're the end user and whether we're small? Who's the end user? Normally, it's going to be the business at the top of the supply chain, the people receiving the benefit of the overall work being done. Sometimes, though, a whole supply of services is made, the delivery of a whole managed project. So, for example, say a business wanted to completely redevelop the way their website works, add in new payment capabilities, stuff like that. You could go to a recruitment supply chain and say, I estimate I need 5 of this kind of developer to work on this project for X number of months. Can you find me those people? That sounds like a supply of resource, a supply of staff. And so the end user is still the business at the top of the chain. If, however, you chose to go to a recruitment provider or, as likely, an expert in the delivery of the kind of work that you need doing, they might deliver to you a whole managed project. So they might tender for, I will deliver the whole thing by this date for this overall price. And I, as the supply chain partner, will decide how many people are needed. I'll deal with all of that. You're not going to define any of that. You're just going to pay me an overall amount, provided delivery is milestones are hit at a certain point in time. That kind of service delivery sounds like the outsourced delivery of a whole service. And in that case, the end user who's originally at the top of the chain ceases to become the end user under the off-payroll rules, and the deliverer of the whole service is now a business in their own right. They're the end user. And that matters because then the size of that business is going to decide whether you're a small end user or not. However, there will be lots of attempts to kind of manipulate the rules in this way. And so what you've got to ensure is that this is a genuine business situation. So you as the end user, are you paying one price for the whole delivery of the project, for example? Or are you still involved in picking the kind of people that you want involved on the project and how many of them there are? And are you going to continue to monitor and control them once the project's underway? Or is someone managing the project going to do that for you? If someone's going to manage the whole project for you, then it's possible that you're not the end user, someone else is. But as ever, get advice tailored to your specific situation. And in the absence of any other proper evidence to that, you should assume you, if you're the end user at the top of the chain, you are the end user for the purposes of the legislation. So the size, therefore, because normally it's the end user at the top of the chain that's relevant, the size of the agency or the recruitment business is usually irrelevant for the rules. It's the end user who's normally the person at the top of the chain. What does small mean? Well, it's a Companies Act definition, and I don't go into it too much detail because there are lots and lots of conditions around when it happens, and there's a year's grace in certain circumstances and so on. Broadly, what it's saying is, on the off-payroll rules, you are small or you're not small for a whole tax year. Tax year runs from the 6th of April 21 to the 5th of April 22. That's the first tax year that these rules will be in place for the private sector. And the rule is that if the accounts that the end user filed in the previous 12 months, so here, the 6th of April 2020 to the 5th of April 21, if those accounts said that end user was small, then they are small for the first year of off payroll. So you look to the accounts you filed in the previous tax year to look at your size for this tax year. And that also means, therefore, that you're not going to change size halfway through a tax year. You're just going to have to assess each tax year, what size are we? Do we have to comply with these legislation, with these regulations? The size criteria, briefly, are You've got to only breach one of these three conditions: annual turnover more than 10.2 million, balance sheet assets, but that's not net assets, it's the assets on the top half of the balance sheet in broad terms. Are those assets over 5.1 million? And do you have over 50 employees? The filed accounts should state their size, but just a little caveat here. Even some accountants do get this wrong. I have seen it get this wrong. The rules are very, very complicated in certain circumstances. But so if the accounts say that you're small, then for the following tax year, you should be small for the purposes of off-payroll. So if you are a small end user, you don't have to comply with the new IR35 rules. The only requirement for the small end user is to confirm that they are a small end user. And this is something I talked to the revenue about a lot. Originally in the drafting of the rules, there was no requirement for a small end user to do anything. And I understand that's because ministers wanted small business not to have any extra burden on them. But my point was that these small businesses already had a burden because they had to know they were small to know that they didn't have to comply with the new rules. So surely asking them just to confirm that they were small was no extra burden, and that now has been put into the latest version of the legislation. So they have to confirm that they are small. They don't have to assess the contractor status or issue any SDSs, and the contractors working for those small end users just have to apply the same IR35 rules they would today. You are the size you are for a whole tax year, as I mentioned before. So for a small end user, you're just going to have to check that that's still the case as you approach each 6th of April. If you issue an SDS and then become small, which is unlikely but possible, then you're required to withdraw that SDS. So as you approach the end of a tax year and your size changes, you have to tell the contractors in your supply chain that now you are not small. Now you are small, so that you effectively are withdrawing the SDSs you issued, so that then the contractors know to apply the old IR35 rules again from that date. Another question we get asked a lot is, what about overseas supply chains? So where is the end user business? If the end user business is not UK based and has no permanent presence in the UK, such as a representative office or a branch or an agent working for them, then the new rules don't apply. And you look at what's the situation immediately before the tax year starts. So in our case, for the first year of private sector off payroll, you'll be looking what's happening in the first few days of April. Is there a permanent UK presence? And if there is, then the business does count as UK based. And if that's the case, the end user doesn't need to do anything. The agency can operate as it does today, and the contractor will operate old IR35 rules, similarly as for a small end user. But do beware, a UK business that seeks to avoid the new rules can't just set up an overseas office and build from there. They've still then got a UK presence. So if anyone comes up with that as a smart idea, I'm afraid, according to the legislation, it does not work. Also, you have to consider where the contractor is. In general, if Dave in our supply chain is not a UK resident for tax purposes, then both the new and old IR35 rules don't apply. There's no UK tax risk for that individual. The IR35 is trying to make sure that Dave isn't underpaying tax. So if Dave's not a UK taxpayer, these rules are not really interested in his situation. So yeah, if you're genuinely non-UK resident for tax purposes, which is not something you can just decide, you either are or you aren't according to HMRC rules, then you should not be in scope. There might be other considerations though. If someone is overseas and not UK tax resident, there may be taxes to pay in the country that they are residing in. You need to take specialist advice if that's the situation. But critically in both these, it's the end user position and the contractor position, not the contractor's PSC, that often is irrelevant, and not the location of the agency. That's normally irrelevant as well. So if you want to pay a PSC that has been decided the assignment is inside IR35, what do you have to do under the new rules? So the fee payer would set up the worker, Dave, as a special type of pseudo employee and apply payroll calculations to the net invoice value. So that's invoice value with a VAT removed and any cost of materials and stuff, and submit RTI info for that worker. There's a special tag they can tick to mark that this is an off-payroll worker rather than a normal employee. The worker's PSC would receive the net pay, which can then be paid onto the worker without further tax deductions. So it can pay, the PSC, Dave Limited, could pay Dave that net pay as a tax-free dividend or as tax-free payroll. But the worker, though, Dave, has no employment rights, no pension and no sick pay despite paying full employment taxes. They haven't even in law got a right to a payslip because they're not a real employee. So for these reasons, most workers, if they're faced with working this way for any length of time, are normally prefer to take a genuinely employed option, direct payroll or agency umbrella payroll. So again, we're back to this decision tree. Normally, yeah, if you're going to be treated as inside IR35 for the purposes of the new off-payroll rules, most workers would rather take a real employed role. But of course, then at the same time, they're also going to be interested in whether or not there can be an increase in their rate of pay, because they're going to end up with less take-home pay, all other things being equal. So can the supply chain protect itself from liability? The end user passes the liability down the chain if it does the assessment using reasonable care and passes it on via a status determination statement to the right parties. An agency in the supply chain will pass liability on if there's another link in the chain and it can show it passed the decision on. So if it receives an SDS, it needs to be able to demonstrate it passed it on to somebody else if it itself is not the fee payer. And if payroll type deductions of tax were not made from payments and HMRC shows they should have been, then they'll go to the fee payer first for those taxes. If they can't collect there, they can go to the top agency in the chain, if the chain has many agencies in it. And if they can't collect there, they can go to the end user. So that looks like this. Here's an example where the end client on the left has issued an SDS, which has been passed down the chain until agency 3. Agency 3 didn't pass it to the fee payer. The fee payer therefore paid the PSC gross, and HMRC have come back later and said, this assignment was inside, so we want some payroll taxes. They'll go to agency 3. They won't go to the fee payer because the fee payer didn't receive the SDS. There is, of course, an underlying legal question here about how a fee payer proves that it did not receive something, but we'll put that to one side for now. But here it's accepted the fee payer didn't receive anything, so they were okay to pay gross. They go therefore to agency 3 for the taxes. If they couldn't get them from agency 3, they go to agency 1. And if they couldn't get them from agency 1, they go to the end client. Agency 2 is ignored because that's how the legislation has been written. So if collection from lower down the chain is not possible due to genuine business failure, then HMRC say they won't use these liability transfer provisions. So the idea is if, for example, agency 3 has just gone bust for normal business reasons, rather than anything to do with payroll taxes or structured avoidance or anything else, HMRC have indicated that they won't use these liability transfer provisions. However, big caveat on that, that's their guidance, which we can take in good faith, but the law is written very broadly to allow liability transfer. Understandably, they didn't want to limit their rights under law in case somebody came up with a clever way to get around them. I can understand that, I can understand the guidance, and I can understand people's concern about whether or not they can trust the guidance. So of course, but this was written like this because HMRC were frankly sick and tired of hearing sometimes end users or agencies saying that they couldn't be expected to know what's happening at the bottom of supply chains. So effectively, HMRC wanted the end user and the agencies to have some commercial skin in the game, so to speak. So it'll be years before we see how broadly they seek to use these powers. And just a note as well, of course, other liability risks, the end user must use reasonable care, and you can find out more. There's a checklist of the kind of things HMRC are expecting to see in ESM 10,014. Reasonable care does not include blanketing, so if you have got a population of contractors and you assess 1 or 2 of them and then apply that assessment to everybody else without doing any more work, that's not considered reasonable care. So you're liable as an end user if you don't issue an SDS, and you should have, and you passed it and you haven't passed it to the right people. You're liable if you can't show, if you're a member of the supply chain, that you've passed on an SDS that you received. You're liable if you don't respond to an appeal or a dispute within 45 days, if you're an end user, more in ESM 10,015. You're liable if you don't answer the "are you small" question. So if you're small, you don't have to do anything under the rules, but if you don't answer the small question, then you can become liable for employment taxes. And a suggested template response to that question can be found in ESM 10,011B. Given all of the above, it might be tempting to just ban PSCs altogether from your supply chain, but this of course is a huge commercial risk. You as an end user, or you as a supply chain, use contractors because you need them to fulfill the work that's necessary. HMRC themselves accept and have accepted regularly that most PSC contractors, of course the definition of a PSC contractor is difficult to arrive at, but the revenue have said themselves that they expect most contractors are outside IR35. Their estimates tend to be around 1/3 of people that they think, looking back a few years, about 1/3 of people using a PSC to work and not paying full employment taxes shouldn't have been doing that. So only 1/3 of people were not complying, they thought. Recent HMRC education seminars, certainly some of the ones that I've watched, show most PSC contractors don't want a role that isn't self-employed. They want to work in a self-employed way. And it's clearly possible, therefore, to use self-employed contractors through PSCs for lots of different situations, just not all of the situations they were previously working in. So the key here is to look for situations where a contractor can work outside and not manipulate an inside assignment with fictional contractual terms or agreements that things will be done that won't really be done. That's not going to work, because the working practices, the real life situation, is not going to change. So a high quality assessment is key, absolutely key to this. So how can you get assessments done? Well, options: you can employ some employment status experts in some way, but some organisations are not going to be big enough to do that. You can use CEST, HMRC's assessment tool, bearing in mind, of course, that it is only HMRC guidance. It's not a legal guarantee that everything will be okay. You can get an opinion from a firm of experts on how you should do this. You can get access to other tools. There are other tools on the market, normally a combination of other online questions, perhaps expert intervention in the right situations. You should consider whether you can insure what's going on in the supply chain, but you need to consider this very, very carefully. You may find that you've got some insurance already and that covers you, and you need to check what insurance you've got and what it does and doesn't cover. So do consider insurance, because this is a new risk. It's sensible to look whether or not you can insure some of that risk away, but be very careful about what you are and are not insuring. You need to involve the whole supply chain in the assessment process. And how can you make sure the solution you use is useful from April 21? I think it's got to be a known and acceptable cost, whether that's employed people, a cost per assessment, a cost per an arrangement you've got. It needs to be able to operate quickly at high volumes. You're going to have peaks and troughs, especially around March and April 2021. It needs to fit in, or you need to dovetail it into your current procedures. It needs to be documented and not overridden, because you've got to be able to show HMRC that you were doing this properly and that you've got evidence in each case that an assessment's been passed on appropriately. The whole chain's got to be happy to use it. And so, yeah, that's absolutely critical. You've got to work with the whole supply chain on this. So what should you do now if you're an end user or an agency and you've not done anything yet towards this, or you're partway through your project? First off, you've got to establish a project team for off-payroll. If you're going to use any volume of contractors going forward on an outside IR35 basis, rather than insisting that everyone is employed going forward, you need a project team for this, because it's going to touch lots and lots of different parts of the business. You need to identify the contractors in your business if you haven't already done that, and then sample assess some of them to look at what kind of an issue you're going to have when you get to April. You need to then consider working practice and contract changes based on those sample assessments. So if you've got lots of very borderline cases, can you make some changes? Take advice, look at those detailed SDSs that you get out and see what the picture looks like. Establish then how you're permanently going to do assessments on a business as usual basis, and what system you use. Will you accept a range of status assessments if you're an agency? Can you do that? If you're an end user, are you going to insist that everyone uses your chosen assessment tool? Communicate with the whole supply chain to understand how ready they are. Are you working with agency partners who are already prepared? If you're an end user, have you already decided exactly what you're going to do and you just need to tell your agency partners? And what do your contractors think about it? If they had a status assessment before, are they prepared to work inside if they previously worked outside? You need to communicate with them now. We haven't got very long to go at all. Find out what others in your sector are doing, and this is important when we come to whether or not you can blanket ban PSCs altogether, in terms of saying, I won't work with them anymore, I'll only work with employed people. If other people in your sector are managing to work with contractors outside when it is appropriate to do so, then you're going to need to do that as well. Otherwise, you're going to lose all the best talent and your costs are going to increase. So you need to establish new workflows to cover assessment, disputes, extension procedures, and so on. So for example, when a contract is extended, you're supposed to check that your SDS is correct and issue it again. If you don't do that on extension, so if extension doesn't trigger that, you risk becoming liable again by mistake. You also need to think, for example, about how you're going to advertise a piece of work. You're going to be able to say that it's outside or inside, or are you going to give an indicative status assessment when you advertise a role? Test, review, and refine all these processes, ensuring, of course, that you've got evidence that you could show to HMRC in future that you've done all these things, in terms of that the process is working on an ongoing basis, and in terms that you've taken the issue seriously and you are using reasonable care in your reaction to this new legislation. Consider then the impact on the supply chain partners and contractors of changing engagement methods, which is going to be around talent pools, the way you advertise, the rate you might have to pay, how happy or sad the contractors are going to be, whether the roles that you're filling currently with contractors are very unusual specialized roles, or whether there are frankly a lot of people who could fill those roles. That's going to have a different impact on what you think about rates, probably from a commercial point of view. Do use external experts to help with this, and review your whole supply chain for compliance generally. You might be using supply chain partners that you weren't using before, or you're going to be using them more than you were before, such as payroll partners. You must be sure that you know who these people are, that you've done your due diligence on them, and you've got reason to trust them with money that effectively you are paying contractors with, but is going out of your hands and into someone else's hands before it gets to your contractors and before it gets to HMRC. Keep communicating from now on. The vast majority of contractors and supply chains are aware of these rules now, even if they haven't decided exactly what they're going to do about them. So I don't think anyone needs to hold back from communicating anymore. And don't rely, whatever you do, on another off-payroll delay. When in March 2020, we heard that off-payroll was going to be delayed because of COVID, frankly, a lot of people should have been prepared long before that. It could happen. It's not impossible. Of course it's not. COVID is still with us. It hasn't gone away yet. We're all hoping that by the middle of 2021, business should be effectively back to normal, but we don't know that that's true, and we don't know what the situation is going to look like in February and March 21. So it is possible. I'm not saying it's impossible. However, HMRC, now the law is in place. Last year, the law was coming soon. The law is in place. So don't count on a delay. You have to be ready to do this. The preparation that you do will prepare you anyway better. If there is another delay, the work you do will still serve you well on a later implementation date. So don't plan for a delay. That's not a plan. So knowing your supply chain, as I mentioned before, you might use payment intermediaries more from April. You're trusting someone else with contractors' wages, so it's crucial you can rely on them. You're looking for businesses that have been around for a long time, not that have just sprung up. They should have a UK base of operations, a UK tax residency for payroll, absolutely critical. You need to use market intelligence to make sure, you know, who are you using, why do you trust them? There's a huge reputational risk to end users and agencies if they get involved in tax schemes or similar. All legislation, all of the trends in the marketplace are towards more and more accountability by the supply chain. It's just not okay anymore to say that you don't know what happens low down in your supply chain. You've got to be sure you've got to do your due diligence. If something looks too good to be true, typically on take-home pay, it almost always is. It's very hard to imagine any situation where anyone can genuinely be paid with less tax due that is legitimate or that HMRC won't be going after. HMRC have also done a huge amount of extra work in the last few weeks, talking when I am speaking, which is in December 2020. They've launched a new campaign about avoiding tax avoidance, and they're also working with the Advertising Standards Authority and others to make sure that the messages that providers give out are not misleading. Obviously, they'll be fighting a constant battle with these people, but yeah, the revenue's eyes are on this more than they ever have. So proceed with extreme caution. HMRC have released some indicators they expect you to use if you're assessing a payroll partner or a payment intermediary to work out whether or not they look like a good risk or not. And you can find that in ESM 10,032. There's also Spotlight 45 on umbrellas, recent work on mini umbrella companies. I won't go into details there, but again, you can find content on all of that from HMRC. So HMRC are more focused on this than they ever have been. A note about rates and contractors. Contractors faced with moving onto on-payroll roles will inevitably and perfectly reasonably look at the rates they're being paid. The legislation, don't forget, the intention of it was that the supply chain would find some extra money for employers' national insurance if the rate is not looked at. If we just say you're on the same rate, the intention is that the supply chain finds extra money to pay the employer's national insurance. So if you're going to change engagement method and move someone from an off-payroll to an on-payroll situation, it's absolutely crucial that the contractor is treated fairly, that they're spoken to, and that they understand they're moving from one engagement method to another. There should be a new contract, and there should be a new rate agreed, even if that rate's very similar to the old rate. They must understand that this is not just the same rate with a different engagement method. Yeah, because otherwise they're going to be upset for a start, and also you're potentially going to end up with a claim for an unfair deduction of employers' national insurance and any other on costs. So, and then partly this arises because, frankly, when contractors accept roles, it's not always clear what rate they're being quoted. So do review how you're communicating about this. Be fair to contractors. A good supply chain will make that very clear to a contractor with illustrations. And FCSA payroll partners, for example, part of the things that we check that they're doing is providing full illustrations that explain exactly how a contractor is engaged and exactly what taxes and deductions will be made from the rate the umbrella receives. So yeah, the contractor should be very clear that the engagement method has changed. It shouldn't be the case that the contractor is left with the impression that, oh, well, you've just moved from this to that, but everything else stays the same. Take-home pay, as I mentioned before, if you're thinking about what could the potential impact be if I wanted to give all the contractors in my supply chain the same take-home pay, then you're moving from over on the left to over on the right. So here, the dark grey box, take-home pay, is stayed the same. The PAYE and E's NIC is going to be a bit more normally than the corporation tax and dividend tax pay. So as you can see, the border between the orange box on the right and the light grey border is slightly above the original rate, but then employers NI and the cost of payrolling people needs to be added on top of that. So the overall cost is quite a bit above the original rate paid if your target is to match take-home pay. The uplifts vary depending on the contractor's individual circumstances and the rates of pay, but an uplift of 25 to 30% would not be unusual if your only aim is to maintain take-home pay. What did we see in April 2017 in the public sector? Supply chains weren't ready for the changes and didn't understand it. Assessments either weren't done at all or were done badly with lots of blanketing. Lots of non-compliant umbrella companies were set up, new ones using loan schemes and other arrangements. Then again, we've seen this now as we approach April 21. End users sometimes just try to leave the compliance to their agencies, but don't forget in the public sector, there was even less chance of an end user becoming liable. Rates weren't increased, especially at low pay rates, unfortunately. So agencies would squeeze their margins and the contractors would end up with a very poor situation on take-home pay. Agencies weren't ready to explain that impact. Often they just didn't know or found that the rules sort of hit them at the last minute. Some end users did use the CES tool, but then found often that seemed very skewed towards inside opinions. It's not always true, but it is the experience that some people report of using CEST. So often people use CEST at first and then move to other assessment tools. Working with agencies and providers allowed those people who adapted their approach to prosper from the disruption, because if you were one of the first people who could work with people who were genuinely outside, then contractors who wanted to work outside would run towards those parts, those sectors and those providers. So if you are prepared, you can expect people to win work from other people who aren't. Commercially, some rates did move significantly and some did not. So where contractors were absolutely crucial to the end result or the work that was being done, often rates did increase. But of course, commercial reality is where those people were less crucial or where there were lots of people available to fill roles, that didn't happen so much. Obviously, the situation as we approach March and April 21 could be quite different, owing, unfortunately, to the impact of COVID and the situation the economy is in now. It's a bit different to what was going on in the background in 2017. Also, of course, in 2017, people who weren't happy with their experience in the public sector could move to the private sector. But now that the private sector is involved as well, that option isn't available either. What do we expect in the private sector? The private sector end users, there'll be a lot of initial banning. We did see this last time round as April 2020 approached, especially from the banking sector. Many banks said that they weren't going to use PSCs at all anymore. Lots of people tried to make some roles permanent. But the thing is, given the commercial impact on this and the impact on contractors, whether contractors are interested in working that way, over time, I think that end users will see that as a problem and start to think about whether or not they should offer outside roles and whether they can, of course. It depends whether you can. If you can, people, I think, will start to investigate that more. Probably not before March. That'll probably happen even more after the rules have come in and they've seen the impact of that when they're trying to get work done. More non-compliant offerings will emerge, of course, as I mentioned before. It will happen again because that take-home pay issue for contractors is absolutely crucial to them. Of course, they're going to look around to see whether there is another way to get paid, but they've got to understand the risks of doing that. And you as a supply chain have got to understand the risks of getting involved in that. Then, as I say, once the dust has settled a little bit, we'll see a rolling back towards the current status quo in some areas, but there are some kinds of contractor who potentially should never have been working outside IR35. And in those sectors, I think we're going to see those people employed on a more on an umbrella basis or other payroll solution basis on a more long-term basis. I do expect to see more of these consultancy arrangements, which I went over a bit earlier, where there is a whole supply of services. I won't go over that again, but as I mentioned before, the point of that is that I do expect to see that happen more often because it is a genuine way of working. It's not just something that's being designed to get around these rules. But of course, sometimes people will see it as an easy way to get out of the problem and maybe not do it properly. As I said before, these things are perfectly reasonable and also is using statement of work documentation if that represents how work is being done. If it doesn't represent how work is being done, then it's going to be seen as a bit of a sham, and then those arrangements are going to be at risk of investigation by HMRC and at risk of falling over. So if you are doing consultancy arrangements and statement of work, if they're genuine, fine. But if they're not, if they're being kind of crowbarred in to try and get around the legislation, take extreme caution. Don't go down that road. So make sure they reflect reality. And finally, then, our feelings as FCSA overall, as a group, I think we would say that no serious person would suggest IR35, old IR35 works well enough as it is. Even government departments have got IR35 wrong when they've used contractors. We do feel there are questions to answer around historic enforcement and so on. It hasn't helped compliance that contractors just don't feel that they're at risk of being investigated when it was all down to them. And there's also a lot of work going on around employment status generally. There's a discussion over whether it should be codified in law or not, and that discussion hasn't been finished yet. It strikes me IR35 type issues would be a lot easier if people did understand employment status a lot more. But the fact is that hasn't been codified. No consensus has been reached on that over 40 or 50 years. And so perhaps it's not reasonable to suggest that that should be sorted out before IR35. However, the legislation as is, the off-payroll legislation is here, it is coming, and we can't rely on a delay. So by taking a serious approach and using a good assessment method and having a renewed focus on supply chain compliance, making sure you know who you're working with, you can work with the new rules. We're working with HMRC on improved guidance, and some of that is what you've seen around the Advertising Standards Authority push and the renewed focus on tax avoidance. They are doing more than they've ever done before. Moving workers to umbrella and other solutions does pose a risk for supply chains, because especially if they're not used to using those kind of providers. So do your due diligence, do protect your reputation. Working successfully though with the off-payroll rules, so still being able to work outside if it's appropriate to do so, will give you a competitive advantage. So it's not all bad news. And we would strongly recommend, of course, that you look for FCSA accreditation in your supply chain partners. FCSA uses independent assessors to ensure people are complying with our code of conduct. So you couldn't have a better badge to give you the assurance that the people you're working with are following the rules. I'll hand back over to Phil at that point to finish off. And thank you very much for listening to my part of today's webinar.
Chris, thank you so much for that. That was incredibly informative. And with all of the other webinars that you've done for us, it well and truly starts to prepare organisations for the reforms coming in on the 6th of April. So thank you for that. There are lots of other resources that you can tap into. If you go to the FCSA website, that's fcsa.org.uk, you'll be able to find a specialist IR35 area, which will give you an awful lot more information than you've seen today and will allow you to go through every single element of the IR35 reforms. So thank you for watching. Thank you for taking part in this, and we hope to see you again soon. And in the meantime, please do visit our website. Thank you.